more, but I think we have SBI cards ready with us.
Well, yeah, that's right. Let's get straight to that one. Then SBI cards, the quarter four numbers, well, the revolver rate improved a little bit for the first time in 2 years. The corporate spends, though, have declined massively, while the net interest margins continues to fall to multi-year lows. Well, we're joined now by Abhijit Chakraborty, the Managing Director and CEO at SBI Card. Hi, sir. Good morning and good to see you, Ben. Well, two-part question. One is on the corporate spends. They've seen a sharp decline. Was it by design or was it due to demand? That's point number one. And the revolver, the percentage has finally moved up, even though it's only around 100 basis points at around 24%. Where do you see this number headed?
So corporate spends is a bit by design. Post RBI guidelines that came in during mid-February, we saw that there is a compliance requirement on the part of the vendors to be onboarded as merchants. And till that was happening, we wanted to be on the right side of the lines, and that's where we went slow on that business. Now, as and when we are seeing that the vendors are getting onboarded as merchants, we will be progressively moving towards that business. And during quarter one, we will be building up that book again. And quarter two onwards, we will be back on full stream on the way we were doing earlier. So that was definitely by design. Coming to revolvers has improved, and revolvers will be a function of the quality of the customers that we have. And there is a tendency from the customers to rather go for EMI based payout rather than continue to revolve over a prolonged period of time. So we encourage both. That's where our total interest earning assets have been growing, and year on year it has grown by 4%, and it continues to remain steady at around 62%. So our total interest bearing book is very steady and constant, and revolver will continue to prevail around these rates.
You don't see it move up closer to around the high 20s, sir? Because that's a trigger for the stock market perspective. They would like to see the revolver contribution moving up.
As I said, we will be definitely looking at a higher number, but then it's the customer preference. If they prefer to move over to EMIs, a larger portion of them, we will encourage that also, but because ultimately it's the overall interest income that matters to me. My loan book, my interest-bearing assets from my overall receivables should be on a stable path, on an increasing path. Revolver is a mixed part of it. We will be watching it closely.
Mr. Chakraborty, hi, good morning. What is the share of spend via these, what you call BPSP, what the RBI kind of intervened on earlier? What is the share of that as a share of spend, percentage of total spends?
That will be, say, around 15%, because my retail spends constitute the larger share of our spends, and we have grown 25%, over 25% on the spends year on year. And it's a retail spends which is my spend, and we continue to encourage it, and it's going to build up.
No, got that. But so you're saying, so corporate spending was about 0.25% of the total, right? And you're saying that this particular segment was about 15%.
It will be around 15% all taken together, and largely it will be coming back in the coming quarters. But as I said, the retail spends will be continuing to be around 80%, and we will continue to build it up.
Okay. What about credit costs, Mr. Chakraborty? What should we expect? Because there has been a bit of stress. Could you give us some guidance, some outline for FY25? Where do you want it to be?
Yeah, the stress we had indicated, we had taken corrective actions. We find that our recent acquisitions for over the last 1 year are behaving much better than their peers in the previous years. So overall mix is going to improve. We have taken various actions on our existing portfolio. So while there will be a slightly elevated credit cost for the near term for quarters, but then over the period of next year, it's going to taper down, and we expect it to remain around and above 7%. But then it will be coming down from the current levels, definitely.
Okay. I had two questions. One is on net interest margins and the other one on asset quality. Your asset quality pain continues for the longest time. Any update on how things are going to move from here?
So as I said, the asset quality, we saw a stress in the portfolio, which was largely because of the overall ecosystem where the constituents who had taken card from us in earlier period, they went into concurrent borrowings and they developed various trade lines, and they somehow have a limited capacity to pay. So based on that, we have seen there is a stress, and that money will come back over a period of time. But then in the current scenario, the stress is going to remain for some time. On the margin front of it, we expected post-November RBI intervention, we expected the cost to go up a bit, and we did go up by 20 basis points, but then that has more or less stabilized. And with the rate cuts that were expected not coming in, we see that margins to remain stable. And even if there is a marginal increase over a period of time in the coming quarters, we will be able to pass it on to our asset.
Two numbers, right? I mean, you spoke about credit costs earlier. I got that. On your gross NPAs, what is your number for the full year FY25? And also on your margins, you give us a qualitative number, but quantitatively, what can the NIMs be by the end of FY25?
So NIMs will prevail around the current level. We closed the year at around 11.3%. So we expect that it should remain around these levels only, because as I said, we'll be whatever increase, if it is there, we'll be able to pass it on. And coming back to GNPA, we closed the year at around 2.76%. We will be able to contain it around these levels, because as I said, the mix of the accounts as it goes forward will help us in containing the GNPA to around the current levels.
All right. So I wanted your view. Kotak Mahindra Bank, they're in the dock post the RBI wrapping them on the knuckles with regard to the credit card business. They're a much smaller player. But your new card acquisition, I think it's moved down to around 1 million per quarter. Earlier, it used to be higher. What is the strategy on new card addition? If you could give us a guidance on a quarterly basis, it used to be 1.3, 1.4. For the past quarter, it was around 1 million. Going ahead, how do you see it move? And do you see incremental market share gains because a smaller player is likely to be contained now?
So our strategy for the quarter-on-quarter growth on incremental accounts, card accounts, will be around 1 to 1.1 million. Reason being, January 23 onwards, when we saw there was we were required to intervene in the portfolio, change our acquisition strategies, and we did tighten up our acquisition policies a bit. So that has an impact on our overall acquisition, and that's where from 1.3 million per quarter, we saw it coming down to 1.1 million. So this is definitely going to happen. 1 to 1.1 million is definitely going to happen. But regarding any market space available, I don't think we will be looking at it. We will continue to look at our policies, our acquisition strategies. Based on that, whatever acquisition comes within our policies and strategies, we will be continuing to focus on it.
Okay, all right. We leave it at that. Thanks a lot for joining in. I appreciate your time here on CNBC TV 18. That's SBI card. By the way, we have lots of stocks in focus, so let's get back to that very quickly. The top